Over to you, sir. I'm going to knock my camera off as well, just so you've got the limelight, okay? But I'm here.
Thank you, Lee. So I'm presenting blind because I can't see hands on my team's screen. So if you can just help me, Lee, with queuing up any questions that are coming up.
I've got you, no problem at all.
Right. Thank you, members, and welcome once more. It's good to see everybody here. And I'd like to thank you once more for taking the time to attend the session. I'm sure you've got a lot more better things to do with your time, but I really appreciate you participating in today's session. The topic for today was inspired by a Netflix TV show named Pepsi, Where's My Jet? So this was addressed to Pepsi. And I'll show the storyline and tell a little bit of that in a moment. So this came to my mind in terms of how it translates into our day-to-day jobs, in terms of how we spend money in principle and where the investments goes. And also demonstrating that value to our key stakeholders across the board. And I'm sure most of us are familiar with those discussions in terms of demonstrating value as it relates to the investments that we embark on. So giving a bit of a background around the title of our session today. It stems from the Netflix show where the gentleman by the name of Leonard some years ago saw a Pepsi ad which said that you could accumulate so many points and own a Harrier jet. Now, a Harrier jet is like one of the fantastic fighter jets you can ever find out there. It sort of doesn't follow the traditional design, and it basically can levitate and stand still, as opposed to the traditional way of flying in terms of speed and trajectory. So behind the scenes, John had this idea that he could collect as many points as possible by collecting caps and stuff, which are Pepsi caps, which will accumulate into points. And then he figured out at some point that there was a loophole in the ad that was posted. There was no disclaimer. And he eventually bumped into this pamphlet that said that you could, in principle, buy the points, which he translated into 700,000 US dollars. So after finding that out, he reached out to the gentleman by the name of Todd on the bottom left, who became the investor. And that became some sort of a business transaction ultimately, where Todd being the investor with the anticipated value, which was the Harrier jet itself, which was worth about $32 million then, and less the investment, which was $700,000. It made financial sense in terms of a quick turnaround for the return and the investment itself in terms of making sense. So what happened was after John spoke to Todd, they put together a check and they included shipping and handling, which was quite funny. But if you do watch the TV show, and I encourage everybody to do, you'll get more or less the storyline. It's quite interesting, and it will hook you in up until the last episode. So the session for today is around that technology investment that we promise to the business. And it could vary from business to business in terms of how we invest in technology. But it's about that value and how we demonstrate that return to the stakeholder and what that return means for us as the CISOs.
Stan, we've got a hand up already. Craig, can I ask you to come in? Craig Joseph, you're on mute, mate. Nope, it's gone down. Cool, no worries, carry on, Stan.
Okay. So in terms of telling the tale, so I call this deck a CISO story in terms of how they tell the tale of their investment and what it means. But this all starts with defining what the actual problem statement is and what you are seeking an investment for and what it will potentially yield to in the long run. So on the screen, I'm showing a sample of how a CISO tale could be told. And this tale is about articulating risk in layman's terms as possible for the business to understand. Now, the gap that we all know about is that the CISOs historically have been techies, and when they talk to business, it's always tech and jargon and this high lingo that the business doesn't understand. So the message here is that your language in terms of telling the tale should be toned down as far as possible so that it's easily understood by your intended target audience or your stakeholder. In the sample, I've got two examples, and you'll see the headers define the risk in layman's terms. I try to be as close as possible to layman's terms there, but it is more or less a guide. And it touches also on the impacted business area. So a high-level statement in terms of what the issue is, which area of the business it affects, and most importantly, what existing controls are in place to manage that risk, if there are any. And that could be in a form of people, tech, and process and governance controls behind that. In this case, I've mentioned just two examples, which is the standard technology and security governance and assurance attestation. So most organizations go through certification in the form of PCI, ISO 27001, as well as SOC 2, just to name a few. And behind that, there are BAU activities such as your SOC and Intel team that forms part of the control in terms of picking up the anticipated risks if they do come your way. And this risk that we're talking about in this case is the risk of a cyber breach to the organization, as I've stated it in the business section there. So to just state this in simple terms, is a risk of a cyber breach to the organization as it relates to the current East and West cyber warfare. And an example of that is the war that's happening now between Russia and Ukraine. And there was sort of an overflow into the EU and also in the US based on the political conflict that was happening as well. So by virtue of our businesses being hosted in the cloud, we're sort of on the firing line as it relates to that, because our services could be picked up and could be exploited if they're not patched properly, for example, and then we end up being a target on our back, and an easy way of making money for the cyber criminals. So that's what it relates to. So the controls could be a long list catalog that you have or maintaining, and access management could be part of that as well. In the next column, we talk about the annual loss expectancy. So this is the assumed quantified number that you say on a yearly basis, if this risk is realized, what would be my estimated loss? In this case, I made it a regulatory fine, which could be in the context of the protection of personal information in South Africa, or it could be in the form of the General Data Protection Regulation, which is GDPR, for the EU-based companies, and also some of the African-based companies that are adopting the same regulations. So after applying these controls to the risk, we end up with what we call a residual risk score. So residual means that with my controls in place, is the risk low, medium, high, and that could be ranked accordingly. And to get to that, normally you use your SMEs in that area, including your information security officers, and you may follow some sort of matrix as well in terms of risk ranking that's defined by the organization to rank it accordingly on a 5x5 map. And that's a combination of a probability and impact to the business. So it's important to have that insight as well. And that normally ties back to a number in terms of a quantifiable number, should that risk be realized. Now, there are other elements that you may want to consider in terms of responding to that risk and the loss, because you could end up in court as a business from litigation. You could find yourself outsourcing a number of services to address the risk if you're in breach and needing to restore stuff. So other assumptions should be considered behind the scenes. Moving over to the right, we're talking about the action that you are taking to address that risk after having articulated the impact, the monetary value, and so forth. Now, in this case, the example is to say, guys, I'm not going to do anything. This is sort of beyond my control. I'm going to rather take out insurance to cover whatever I think should come my way or will come my way should a breach be realized. And in this case, the estimation of the cyber insurance amount on an annual basis is $5 million to cover a $20 million risk. So what's important here and what's stemming out is that the cost of managing the risk, right? It could be technology, people, process, governance, and any BAU functionality or operational services should never be above the actual risk amount itself. So what I mean by that, it wouldn't make sense for me to spend $20 million to address a $20 million risk. And also, once you start getting to the 50% mark, say $10 million to address a $10 million risk, it starts to become sort of a bit contentious in terms of whether it's worth a while to put so much investment in that risk in terms of maintaining it, or maybe the business needs to stop doing something, or maybe take a different approach in terms of either eliminating that risk or reducing it further with other initiatives. I'm going to pause there before I sort of sprint into the next one and take any questions if there are any.
Anybody want to jump in? You've got applause and plaudits coming in. Well said, Stan. Risk mitigation is not always the answer, right? We also have a hand up from Werner. Nice to see you here, mate. If you want to jump in, unmute yourself.
Yeah, I have. Thanks. I think, like, one of the things, just as a comment, you were talking about an ROI. I don't always know that what we do is an ROI, but you covered it as a risk mitigation. I think that's more it. It's not really, it's not always a return on investment, but there's definitely risk mitigation.
100%. So ROI could be implied. I mean, in this case, we are not buying my favorite ML63 AMG Mercedes SUV, right? To buy bread and milk twice a week. And I like making that analogy and an example when you sort of weigh ROI. So if there's a tangible asset that the business is buying, that would be in a different stream. Like we're buying a property, for example, or a big building. Then we start talking about ROI and the time frame behind that. But depending on finance models, you could take a capital expenditure approach, which you sort of sweat over time. You end up with scrap and then write off your asset after, say, 5 or 10 years, if that's the case. Or you could take an operational approach where you're funding your initiatives through operational expense on a year-on-year basis, and you're able to levitate towards the best capabilities for your security investment. And that way, you're not bound long-term in terms of your investment. But the end goal is to, regardless of what finance mechanism or path you follow, you should be able to demonstrate some sort of value to the business at some point. In this case, we are showing that we are investing 5 mil to address a 20 million risk, right? As to how it translates in terms of demonstrating and benchmarking around that, I'll touch on that in the next slide deck. Ali, are there any other questions or hands?
No, you're good to go.
Alrighty. The next example is around, I think is what most businesses are struggling with in terms of managing data leakage, especially around the process perspective. So if you look at the O365 estate and the Microsoft capabilities, they have some DLP capabilities that you can switch on. But when it comes to roles and responsibilities, that's always a gap. In some cases, you find that there's not even a tech to help an organization to do that. And in jurisdictions such as the EU and South Africa, in a form of POPIA, or the protection of personal information, there's now more requirements, and regulators are compelling us to start switching on some capabilities in order to protect personally identifiable information. So for the risk item number 2, as an example, is defined in simple terms, lack of business-wide data leakage protection. But that could be expanded further to say, what does it actually mean in simple terms? It means that there's a potential for data to be lost, and that data could be financial. It could be health records or special person's information. But it's in the data, call it the privacy and data protection space. in terms of regulation. Now, the impacted business areas in this case is the entire business as a whole from a reputational brand perspective. And also the customer side, where you could end up with litigation, for example, if somebody's identity was fraudulently used and there was a big loan taken out on their behalf. And if they're able to demonstrate that the company or the organization is liable for that, we could end up with bad media press and maybe potentially regulatory fines as well. So to control that, as usual, you always cover the governance stuff and assurance. So all your sets, the annual audits that you do, and so on. And in this case, we are also placing reliance on a privacy incident response, which I've not seen in many organizations, but it's something operational that could be considered to make sure that should there be a breach that is realized as around PII, then the business is able to respond effectively in terms of the media press, engaging with the respective stakeholders and the board in terms of what it means and what the next steps are. This one is similar to the previous one in terms of the potential loss for the year. So if we have one occurrence, we are assuming a $20 million loss. And also you'll see that the proposed mitigation in this case is a technology solution. Now, every piece of tech that is enabled out there requires people headcount. So that I've not considered, but you could put a number to it as well to say from a people, process, and tech perspective, these are the assumed sort of annual amounts in order to manage this potential risk. And that could be spread either across business units or managed as funding at a call it group level, depending on the hierarchy of some of our organizations. So those are the two examples I wanted to touch on and just share an example in terms of the rationale around addressing specific risk. And the takeaway here is that the amount of the monetary risk amount that you're addressing should stay as well, the amount of money you're spending to address a particular risk should always stay as low as possible. And where it doesn't make business sense to continue investing money in that particular area where you are managing the risk, consider alternate options, even if it includes stopping a business process in order to either eliminate or reduce that particular risk. Now, once we get to a stage where we have told a tale to our investors in a form of our strategic goals for the year, and we have received support from leadership in terms of the monies to spend. Now we have to demonstrate how we are doing in principle from a CISO office or cybersecurity and information security perspective. This slide talks about what I call the balance scorecard. There are a number of variations of this scorecards, but this is a simple framework that helps the CISO office, you might call it the information security office as well, in managing performance objectives, and in some cases done on a month-by-month basis. This allows the business to be agile in principle and to levitate towards where the issues are or the risks or the areas needing attention are, and also seek either a steerco or leadership support behind the scenes. So when investing in tooling or security technologies, in my experience, there has been cases where it's like something that's nice to have to switch on. But I think what's important is to, before you go down the investment route and funding that, always understand your as is. And your as is can start with a balance scorecard in terms of addressing, for example, the various aspects. So if you look at internal processes, that could be specific to your CISO office, and you could translate that to governance and assurance, or you could translate it into cybersecurity operations. The financial element is common across most balance scorecard, where you are talking about return on investment, if you have any investments that are yielding and appreciating over time. Cash flow will be talking to your income statement or your statement of comprehensive income. And maybe you could touch also on a balance sheet, depending on the finance model in a particular business. Now, ultimately, The CISO office, in the form of a balance scorecard, demonstrate on an ongoing basis, such as a monthly basis, where the performance areas are, how we do in terms of trend, whether our risks are going down, going up, or if there are any new burning issues to address at the same time. The education and growth aspect is very important, especially when you switch on technology. There has to be a change management aspect to that, to make sure that the kit that you're putting into your business has got the right support. And that can be in a form of internal capacity, or it could be an outsourced service to a service provider that you engage with in order to enable that technology capability. The customer relationship aspect is always outward facing. So we're looking at the CISO office and the customers or stakeholders that you serve. And normally that would be the cross-functional departments such as your HR department, your training departments, your IT operations, and so on. So this is like a metric that influence all the dimensions in terms of perspectives. So it could go either from a left to right, clockwise or anti-clockwise, but you'll see that once you start keeping track of this together with the trend on a month-by-month basis, you are able to levitate towards where the biggest risk is that you need to address. And it could be across each perspective, as I've articulated now, which is the financial, the learning space, your internal processes, and any customer-facing delivery that you carry out. I'm going to pause here for questions, Lee, if there are any.
No questions, no hands raised. Anyone want to jump in? Any comments, statements? Anyone want to call any of this? I won't say the word because it's recorded.
So
Anyone
it
want to
seems
call
like
out?
our audience know exactly what's going on. So I'm more than happy to take questions offline if there are any.
For sure. Yeah, sounds fair. But if anyone wants to step in, please raise your hand. Okay, carry on, Stan.
Okay.
Thank you.
Right.
Sorry, Stanley, I've got a question for you. Just in terms of the balance scorecard, with regards to the metrics, do you have an example of what you've defined as the sort of key metrics for your discussion with the board around your investment and how you're tracking?
Yes, I mean, let's give an example of an easy one, right? So most businesses have to embark on a cybersecurity awareness program, right? Now, that program is defined in terms of mandatory training or optional training, for example. But if you look at your metric, which is mandatory training, and you peg it and you say, once a year, all employees must complete their cybersecurity awareness e-learning for the year. So your metric could look like 100% completion of the annual cyber awareness training, as well as managing the consequences behind that in terms of consequence management process, meaning HR process, for the areas where there's non-conformance. Now you could take that and translate it downwards, and meaning cascade it further down to each head of the business unit or to the CISO office and further down to your information security officers as well to oversee. So the metric in that case, which is the high level metric that a CISO would promise, is your 80% mark in terms of completed cyber awareness training. Now, if you look at the SOC space, or maybe call it the CSIRT space, your cybersecurity incident response team, you could mark it as all CSIRT incidents managed within 24 hours. So the 24 hours is your number, right? So what's important here to state is that there must always be something quantifiable that will help the CISO in terms of sales pitching to their stakeholder to say, yes, I've met the KPI or I've not met the KPI. On the finance side, the KPI could be 2% reduction in your run costs for the year, right? In terms of how that is translated, it could mean that you need to renegotiate licenses. You may need to readjust people count and any other initiative that would help you to get your 2% reduction in your expense. So those are the simple metrics, just be an example under internal process and the financial aspects.
Comfortable with our response, Mr. Naidu?
Yeah, I'm coming back. Sorry, a bit slow on my mouse. Yeah, the only concern for me is that are we, are we focusing on outcomes or outputs? For me, when you're measuring whether somebody's completed training or not, that's an output, not an outcome. An outcome for me would be, how do you measure, reduction in risk? I don't think there's any simple answer to that, but again, I was looking at, key risk indicators and
Right.
how would you measure the key risk indicators? So, from a key performance indicator perspective, you've done your work in terms of rolling out the training, you've got your 80% coverage, but it doesn't translate into key risk indicators, and that's my concern in terms of looking at it like this.
Right. So if I take you back to this slide deck, right, where the CISO was telling the tale in terms of the risk they're addressing, one of the controls could be 80% conformance on cyber awareness training, right? So by ensuring that conformance level, in principle, what you're doing is you're strengthening your human or your employee firewall, right? So it helps with the risk reduction. In terms of quantifying it, you can show a trend in terms of a year on year. Year on year, our training has been at 80%, for example. And as a result, touch wood, we have not experienced any significant security breaches, right? So I make an example here in terms of just cyber awareness. But if you take it now to the financial aspects in terms of KPIs, it could be a year-on-year reduction on your expense line, which could be a 2%, 3%, regardless of what it is. In some cases, I've seen up to 50%, right? But it varies from organization to organization. Now, coming down to internal processes in terms of how you manage your key risk indicators and how you communicate that, there are a number of swim lanes that you could consider. So you have your internal audit activities. They yield findings. The findings are high and critical and so on. You have external audit tracking as well. You have your own risk register as well that you're tracking with supporting mitigation plans that are quantifiable in terms of who's the owner, how much you're spending, when is the initiative going to be rolled out, and when it is rolled out, are we writing off that risk as resolved and no longer existing, or have we just reduced the risk, which will take you down to re-ranking? So having a holistic view of how risk is managed in the CISO office, maybe it's for a different topic, but for this topic, we focus on just the financial aspects to say, when I spend money on a piece of kit and I spend a bar, for example, what is the value that we are deriving out of that? And which leads me to the second slide here. And I'm going to continue just from here to say that if you take $1 million and park it in the bank and it earns interest of 7%, you look at about $70,000 of return for doing nothing in principle, right? But as an investor, the general rule of thumb is investors are asking a 20 to 30% per annum return. So when you do your sales pitch with your sponsor or the business, you need to demonstrate value somehow, right? And that value is quantified and can be qualified as well. And if you go down that stream, you have to show how the investment is improving the internal processes and reducing administrative tasks, if there are any, and manual processes. You should also show how that risk that you're addressing, right, is aligned to your tolerance levels. So by investing so much, are we reducing the risk or just maintaining, or are you planning to eliminate the risk in terms of our mitigation plan? And also coming back to that, it depends on your financing model, whether it's capital-based or expensed. Now, what's more important as well is to make sure that there's what I call residual business value that's created by your investment. So those are the call it the qualified items that you say our human firewall is stronger, but you can't really put a number to it to say my human firewall out of cyber awareness training, they are now more mature. But you could embark on other activities, like do a phishing campaign to test who's going to click based on the difficulty of that phishing campaign. So there are a number of ways that you can sort of measure that. And these are just the takeaways in terms of the investment mindset, right, of the CISO to say, always think about the outcomes, whether they're qualified or quantified, and articulate them to your stakeholder in such a way that it's an easy to understand narrative. And also you're able to prove or demonstrate that the investment did yield a return for the business by improving processes, reducing risk, and creating additional value in the long run. With that, I'm gonna.
Sorry, Stanley, just a quick question.
Okay.
So I like your statement there, $1 million, you know, interest-bearing account at 7% equals $70,000, and you said do nothing. What if you did nothing, and then you had a major cyber breach?
Right. So just to clarify on this $1 million, right? So our business stakeholders are like investors. They choose from their balance sheet whether to invest money in cybersecurity technology, right, or to leave their money in the bank and be consecutive and earn that $70,000, right? So that $70,000 could contribute towards paying a fine, for example. So if your sponsor comes back to you and say, but I have R1 billion in an interest-bearing account and is generating so much per annum. So if I do get fined, I'm happy to pay the fine. So each CISO should be in a position to defend that case. Because what the stakeholder is doing here and the sponsor are doing are saying that because I have the money and you're not giving me sort of definite guarantees that I'm going to be breached, then I'll just pay whenever I have to pay when it gets to that. And then they may say that the efforts that I'm seeing, they're not showing me why investing in the CISO office and the technology in terms of people and process as well is better than parking money in the bank. So that's the sort of the storyline behind the mindset that I'm referring to here.
Shall I take your silence as contentment?
No, no, it's not. I think it's probably highly debatable. There's different perspectives.
It is.
You know, it also goes
Yeah.
to the fact that we've got things like King 4 and COSO 2 and, you know, whatever else. So there's always due care, due diligence. So, you know, yeah, I think it's a simple statement, but when the chips are down, I think it's a different story. And then if you look at what's happening from a market perspective in terms of cybersecurity investment, I read a report recently. 2022, there was a global investment of $154 billion. And by 2026, it'll reach something like 276. So we continue to invest heavily, you know, globally. And it's interesting, in South Africa, it's roughly right now, it's about $400 million and expected to grow to about $500 million by 2025. So there's clearly some serious investment going into the space. So yeah, I'd be quite keen to see any company out there that's not investing in this space. So that's why I'm asking, you know, so $1 million in the bank versus $1 million in cybersecurity or whatever that investment number is. It's an important one. I think, you know, from my own experience, I think boards are, or, you know, the oversight bodies are extremely prudent when it comes to oversight in terms of, you know, do you spend or not?
Yeah.
So it's
100%.
yeah.
So I mean, if you take it back to why the investment, right? You look at why the organization exists, right? They exist to create stakeholder value or shareholder value. Now, if you are generating $1 billion a year and you are investing $1 billion in security, it doesn't make sense. And the shareholder always wants to protect their investment and their equity in the long run. So this narrative is coming out of that to say that our shareholders and sponsors, right, they have money, but they want to see return from their investments. Now, the technology and security investments may come across in some cases as a grudge spend because the CISOs are not able to demonstrate the value on how we're protecting the core service or the revenue lines that are generating value for the business. So at some point, it becomes, say, a numbers game, but also it's important to take note that not every business is the same, and the mindset that is being referred to here is that always put yourself in the shoes of the investor or the shareholder. They've got this money in the bank. They're wanting to know where it should go in terms of the next opportunity. Now, the CISO office is going to be like not a loss account, but if we throw money at a technology of some sort, right, there must be an indicator that shows that we are enabling the business, we're protecting the asset, which is the core services and the core asset, and that we also maintain a risk as low as possible. So it comes down to that whole narrative in terms of a holistic view of how risk is presented and understood by the shareholder and the respective stakeholders.